Well, good morning, traders. This is Blake, and you are listening to the Face Show. Yes, I am not Dale. Dale is out for the week. For those of you that did not know, he's out traveling, visiting an old school friend of his in his hometown of Chicago. So we got myself and Steve and Stelios and Ryan joining us here, and hope you guys are having a great week. All right, I want to also say, because I've been missing the round robin that Dale loves to do around here, and I miss it too. So, good morning, AJ, James, Bran, Marcus. Happy Tuesday to you as well, Glenn, Ryan, Hugo, Forex Gal. Good to see you, fine lady. Paul and Patrick. Good morning, everybody. And yeah, so we are seeing. I guess we should probably talk about the dollar move that we're seeing this morning. We are seeing actually the euro move lower, broke below 111. Sterling broke below 133.50, took out channel support. You can see this is the ascending trend line of the channel. There is a channel there. You can probably see it just like that, but you can see that we've broken through that channel. And, so we've seen overall some dollar strength come through the market. The commodity currencies, though, are still holding up relatively well. And you would expect that. I mean, you'd expect that when stocks are trading basically at all-time highs. Now, speaking of the stock market, late in the day yesterday, what do we get? We got a nice little boost in the market right at the end of the day. We had all the end of month flows come through the market. And, just when you thought the market was going to roll over, nope, ain't happening. And so we saw some, like I said, we saw some, U.S. equities, playing through to the upside. Now, whether it's going to be sustainable or not has probably more to do with obviously the incoming U.S. data. Yesterday was kind of a slow data day, but for the next 4 days, it's going to be bunkers around the market. And if you don't know what's coming out all week, well, you can just look at ForexAnalytix and take a look around on the calendar. We are going to have ISM data today, which is it's the manufacturing ISM data, which has continuously been and notoriously weak globally. It's not just US data that's been weak, it's been just kind of global weakness. But we're going to be looking at not only the employment component inside of the ISM data, which is right here, you can see it right there, but we're also going to be looking at the JOLTS data today. That's going to be the biggest market mover today, will be the JOLTS data. And if you guys haven't paid attention, there's a port closure right now happening, and there's been a lot of ruckus about that over the course of the last 24 hours. But we have had a new trader in our chat room, Christine. She was asking about it last week, and she brought it to our attention, and we're like, yeah, you know what, we're gonna have to pay attention to that next week. Well, the whole market is actually paying attention to it now. They're all starting to wonder what the longer term implications are going to be. And it's kind of like, how should I use the example? It's kind of like when we have not to as severe of an extent, when we have a government shutdown, right? It's one of those things. It's like, it's not a big deal at first, but as it prolongs, it can become a bigger deal. After doing some research on the subject, a lot of companies have ordered in anticipation of this strike, and the strike has to do with wages, right? As inflation goes up, all these unions are, we demand more money. We should be, we want our assurances. We don't want to lose our jobs, but we want more money. So all these ports, one of the biggest, port unions are striking basically, and that could be a big deal if it continues on. If the negotiations fell through last night at the strike at midnight, they didn't get a deal done. So yeah, we're going into you're gonna have some port closures. As long as that doesn't extend, throughout the next week, once you start getting past this weekend, and if things haven't been resolved, Then you start looking at shortages, and then after shortages, you start looking at inflation. So again, I think most of the world would expect that they get past this in a fairly short order, but it is a situation that we're going to have to pay attention to. Ryan, if I'm not mistaken, over on the Flow Show, you had Ryan from PIQ Suite. You also had Michael Brown from Pepperstone joining you today. And you guys did have some discussions about this as well. So what were you guys talking about as far as the port closures?
Yeah, well, we were speaking about this early September when it first started rearing its head. But like you say, it's one of those things you can have an early heads up on what it's going to do, but until it actually comes to fruition, the market sort of ignores it until the last minute. But everyone's focusing on it for the possible impacts. We should know how it's going to play out because we had a similar situation over COVID, if you remember, with all the ships being held out of port and so on and so forth. So it's really a case of how long it lasts for. And I posted in the room a piece that I put back in September from Sea Intelligence, which said that a 1 day strike would take 5 days to clear. A 1 week strike in October would cause slowdowns until mid-November. So, it only takes a short amount of time to increase how long the impact from this is and the backlogs to get cleared. So, yeah, it's something that is going to play potentially into economic data. The longer it goes on, it's going to, potentially see maybe a bit of a jump in activity, whereas you say people have, front run it and ordered stuff in anticipation of the strike. So that can be a little bit of a boost to growth. But then if it goes on for longer, then we're going to see that reversing, going the other way. And then you obviously got the inflation impact. If people can't get hold of stuff, they end up paying more to get it from elsewhere. So, yeah. But that's all stuff that's gonna come around in the future. It's probably not anything we need to worry about just yet, and not anything that the Fed will certainly worry about just yet.
Right on. Yeah, and like I said, it's something. Let's just keep our ears open and just have awareness, because it could eventually affect the U.S. economy in a big way too. I mean, you just start cutting off supplies, and if I can't get toilet paper, well, I got problems. We all got problems.
We're not going down that road again like we did in the pandemic.
Just kidding. We get that from our trees up north. Anyway, so what, Ryan, you've been, like I said, you've been up and doing the Flow Show, and if you guys don't log in and listen to Ryan and his group, usually he has K-Man around. Make sure you go to our webinars page on ForexAnalytix. Right here is the Flow Show. You can hear Ryan every morning. I actually catch the YouTube stream. The stream, it's, I catch after the fact because obviously I'm sleeping during the show. But he usually has K-Man with him. Today he brought in a couple of guests. And if you guys don't know how to get to it, just go right to our website, go over to webinars and log in. It's free to listen in. Ryan, what other things did you see that was moving the markets obviously overnight, because we did have a lot of economic data?
Yeah, it was. You mentioned that it's the dollar's doing a lot of move today. It's actually the yen that's doing a lot of the pushing and pulling in markets today. I mean, I sat down and I woke up, dollar yen was trading 144.20s. Time I got to my desk and started up.
We almost hit that 618 retracement. Just from the fall after the new incoming Prime Minister Shiba, when he got elected. I'm sorry, I didn't mean to interrupt here, but one of the things on the week ahead video, if you guys didn't watch the week ahead video, I said, look, I'm long dollar yen. I expect a recovery in the dollar yen. That was a lot of end of month flows and a little overreaction to a Shiba. We got the recovery. It was a big recovery too. I mean, you're talking a 300 pip recovery, and now it's moderating, and now we're waiting for data, right? So I'm sorry, go ahead. You saw the yen move.
Yeah, so I was in the same boat. I was buying it from last week. I started 143.60s. I bought it all the way down to 142s, and yesterday morning, Monday, it was looking like a really crap trade, and then today it's completely turned around. So I've already taken profit, locked in my trailing stop into profit. So that's all looking good. But it flipped pretty much on a switch. And, you know, we talk about the Mr. 8 a.m. man here in Europe, where all the models and whatnot come online about 8 o'clock in the morning here. It looks like there's been a bit of flow, new quarter flow perhaps, or the models adjusting to what happened at the end of the quarter. So really that turned on a dime this morning at 8 o'clock, and we saw a big drop in yen pairs from that high. That's now been matched with a bit of a drop in yields along the curve, mainly if you look at 10-year yields in the US. We've seen a bit of a dip there, which is added to what's going on in the yen. So, you know, it looked like it might have been recovering back towards, you know, that 380s, 381 highs. But it's come off again 2 years and not doing an awful lot. So we're just seeing a little bit of a flattening in the curve, whereas we were seeing it steepen a bit. And I think yen's responding to that, and that's doing a lot of driving at the moment.
And I think this is a big deal. I mean, you look at the Eurozone, 10 years are coming down, and I'm gonna flip it back over to the boons, just because. Whoops, wrong chart, wrong subset. Look at boons here. Boons are actually threatening for a breakout. You know, so yeah. What's happening there? Whoops, that's the DAX. Sorry, to get over.
Well, we had Lagarde yesterday, pretty much cementing an October hike. We've had CPI data, which now has come through the ECB's target. Well, sort of come through the ECB target. It's below 2%. The expectations yesterday were for it to come in at 1.9% from 2.2%. Those expectations got revised down to 1.8% after the German data yesterday. So it came in the end as expected at 1.8, but it's below 2%, and that's the magic line for a lot of central banks, although the ECB's mandate is below but close to 2%. So we're bang on for October now, for a rate cut in October. And I think that we're seeing that reflected in yields, that particularly European yields, that the ECB may be going a bit faster than was previously expected. And that's your pressure there in yields.
All right. Well, you know, yields are starting to come down, but what about the data today? I mean, we've got, like I said, we've got JOLTS data, we've got US ISM data that's expected out a little bit later today. I mean, I think the market is really pricing in you know, the worst case scenario for the US. That's one of the things about you know, expectations for the Fed. You're seeing you're seeing the market price in what, 150 more basis points of cuts. I mean, I mean, isn't this an example of when, you know, the market's just, they're expecting the worst, and then next thing you know, how about if you know, we get through the end of 2024 and data looks good and jobs market hasn't fallen apart? I mean, what are yields going to do, and what's the dollar going to do in a response to that?
I don't think today we've got a market getting too negative over the US, because we had Powell yesterday. Again, he felt the need that he has to come out and straighten out the market a bit from getting too dovish. You know, last week we were pricing a 50 basis point cut at, you know, 58, 60%. Now, after Powell saying it's likely we only get 2 more cuts and they're both going to be 25s, the market's run the other way again. So he felt like he had to come out and, as I say, straighten out the market, you know, give the doves a bit of a poke in the eye and say, you know, don't get too dovish. But it's, again, you know, if the data today stinks, then we're going to swing the pendulum again, and the market will start getting all 50 pip cut again.
Well, okay,
that's the way we're in at the moment. We're going to swing around the data points. But if it's hot, like you say, if it's a good number, well, then the hopium trade kicks on again, and we see commodities rallying like we did last week.
Yeah, and take a look at the dollar index, guys. I mean, the dollar index was in this wedge. We hit the top of the wedge yesterday. We rejected it, you know, in North American trade. We actually slumped back below, you know, that trend line yesterday. And then all of a sudden today, you know, here we are well above it, and the euro's extending its lows, the dollar's extending its highs. And I think what's really interesting here is everybody was very downbeat on the dollar. Here comes the dollar, rip roaring. And what happens if the data is just strong over the course of the next week? I mean, I'm talking the next couple of days. But at the same time, and I'm going to bring in Steve really quick. Good morning, Steve. Steve, he did a chart of the day today, and he was discussing gold. But he's been talking about gold over the last couple of days. And Steve, you said, hey, instead of looking at levels to be on the short side of gold, why not looking at levels to buy it? And gold came down to a pretty key level as far as you're concerned, right?
Yeah, backtested the broken channel trend line resistance as support, and I'm not saying that it is unlikely to have more downside before the uptrend resumes, but we're already seeing a reaction from there. And, from those of us that have been listening to us, and there's plenty of people for years, they know one thing for sure, is that I never ever wanted to be on the short side of metals. And it's not because it's some kind of a taboo or superstition or whatever. It's because the fundamental reasons for benefiting metals, with the primary beneficiary being gold, have been there for years. And unfortunately, as the years go by, instead of receding, they become even stronger, the arguments for owning them.
Yeah. Yeah. And, here, I was actually talking to a person at the gym yesterday, of all places, about gold. And the thing is, I can't argue. There's no reason not to own gold. I mean, that's the thing. And I know gold is readily available. And I wanted to talk to actually James yesterday. And James, by the way, who we brought in as an interview, he was he apologized because he just moved back into the United States and his router wasn't working correctly. He apologized.
These things happen.
Yeah, we're gonna reschedule to have him come in. He's a precious metals dealer. But like I was saying just a second ago, I don't see any reasons not to own gold. And usually when I don't see a reason not to own gold, it probably means the market is lopsided from a positioning standpoint. Doesn't mean it should go down, but the risks are amplified that it could go down just from a positioning point of view. But right now,
nothing moves in a straight line. And of course, gold is going to have pullbacks. And I mean, it's been in a massive uptrend. At some point, it's going to have even a stronger type of a pullback. Perhaps, the catalyst is going to be some change in monetary policy. Perhaps the catalyst is going to be some kind of change in political will having to do with fiscal policy. But in general, and as you said, sometimes the reason is just a short-term squeeze of the market, because those are part of the game as well, undeniably. But one thing is for sure, gold, in essence, as anything that has intrinsic value, is readjusting its price over time to keep its real value more or less balanced, right? In essence, gold is the best way. Who was the one that was saying that? Was it Volcker? He was saying that for me, the best gauge of if monetary policy is loose or tight is the price of gold. So imagine what gold has been telling us during the past 20 years, right?
Yeah, our monetary policy sucks. Doesn't matter. It's extremely loose, right?
Yes.
Yeah.
Exactly.
Right.
And by the way, it was Greenspan, now that I remember. It wasn't Volcker, it was Greenspan that was saying that. So when he was asked quite early in his career, he was saying that, for me, the best gauge to see if our monetary policy is loose or tight is the price of gold. Imagine.
Right. Well, I mean, at some point you would think that monetary policy would tighten from here. But even as it has though, and rates have gone up, it still hasn't affected the price of gold, that's for sure. So
It hasn't, because the rates temporarily went up as a response to inflation, but real rates during the whole period remained from negative to deeply negative. I mean, even now that supposedly inflation is, let's say, 3% in the US and rates are higher than that, yeah, theoretically speaking, if you take into account the reported inflation, real rates had been a little bit positive for a period of time. But if you take the actual inflation, they remained negative. And let's not forget that for the vast majority of monetary policy history, it was considered to be insane to have anything but constant positive real rates. Because if you do not have positive real rates, and we had that even when we were reporting inflation honestly, not dishonestly as we're doing now, what is the incentive that you actually give people to save, right? And don't forget, savings is the steam engine of any economy, because savings is the pool of money that actually funds the expansion of an economy, right? Investment. That's where investment comes from, savings.
Right. Well, thank you, Steve, for your insights on gold and on monetary policy. It is very much appreciated. We have about 9 minutes, and I'm gonna go over just a couple of setups that I think that are in development. I want to get Stelios's views here in just a few seconds as well, and see if he has any charts that he wants to show. But ahead of all this data that's coming out, let's talk about the euro, because the euro, we had this bull flag pattern. We've been stalling ahead of that 112 level, and I want to mention, if you go back to when the euro traded at 160, and that was way back here pre financial crisis, you can see that descending trend line comes in right around 112.50. We have not been able to scale above 112, and now we are at risk of a bigger development, which would be if we break back below 110. Then we have a big double top that actually takes us back to 108. And I think that would be a surprise to a lot of people. A lot of people have been expecting a weaker dollar, going into this year. And so, at the end of the year, having the dollar, or the euro dipping back below 110 and breaking back through 108, I think would be a shocker to a lot of people. I was just over the weekend having somebody comment to me on the euro, thinking that the euro is going to like 120 by the end of this year. On my week ahead video, I'm like, okay, well, good luck with that. And sterling, this is one that we've just broken an ascending channel. What if we break back below 132.70? Now, Ryan, I gotta ask you really quick. When's the budget come out? UK budget? It's the end of October, isn't it?
Yeah.
Okay. How do you feel about sterling up here? I mean, technically we haven't finished our flag. We'd have to reach all the way up to 136 to complete this flag pattern. But sterling's been on a rampage. But do you expect sterling to continue to hold on to the strength?
I expect it to maybe hold on a bit more than some other pairs. Like you said, euro looks like it might be on a breakdown. If we go through 110.70 here, then we could be going down to 110 pretty quickly. Cable's holding up a bit better. 133 is my line for that at the moment. Just that, we had a little break up there and we held it last week. Yeah, just been there. So that's the level. But there's a lot of pairs doing similar. Aussie dollars just trying to cling on to that 69 level, but the bigger level is 68.70. So if we break below there, then we're going to see a further washout. So yeah, Cables has that exceptionalism still. It's holding up better than some of the other pairs, the euro in particular. And like you say, that's reflected in euro sterling as you just showed there quickly.
Yeah.
Which way, like, you still in your longs? I'm still long, and It was
Yeah, I'm
looking
down
okay
6 pips, but
morning.
I'm managing them. So
Yeah, it was looking okay this morning when we were trading up at the 30s, nearly 40s. But it's come back down again. That euro speed, it's going quicker than the cable. So yeah, listen, if it holds this 133 area in cable, same as Aussie holding the 69, then we should get a bit of a bounce perhaps, and have a look back at those highs. But if we get under those levels, then we're probably going to see a bit of a further washout.
yeah. All right. Well, I think the sterling looks a little vulnerable here. Hey, Stelios, I hope you're feeling a little bit better, and just wanted to real quick get any views that you had on the markets this morning
Yeah.
that you might be looking at.
First of all, I just want to say I read about Gavin Newsom, governor of California,
Oh, that guy's awesome.
passing a bill that it's now illegal to require voter ID. So basically, I can go and vote, which is great. It's been my dream to vote in California. Anyway, so markets. Well, we talked about quite a few things yesterday. If you recall, I did say I think that the Dixie could bounce towards 102, especially if we get some good data. It's on its way, I think. But my general view remains that this will resolve to the downside, as will yields, because let's face it, every central bank pretty much is loosening policy. And yes, the Powell yesterday talked the talk and tried to make people believe that no, it's not going to be as much as the markets expect. I always say, look at what they do rather than what they say, and what they are doing is easing everywhere. So my macro view, of course, you can't trade off this in in the minute chart or the 15-minute chart, but my view is still the same, and I'm looking perma bear. I will lose again. You think so? The Dixie has gone quite far lower. So that's an interesting view you have. One of our friends wrote on the chat. So I think that's how it's going to resolve itself, and the same with yields. And I've been saying this for a while, and it's been going lower. So I'm happy for that at the moment. But as you said, Blake, if we get a couple of strong numbers, especially if the payrolls on Friday are strong, we could see a little bounce. But I think it's going to be a selling opportunity for now.
I've been playing the dollar on the long side down here, just because I'm also in the camp, and I don't, because we don't know. Tell me what happens when we have some risk aversion. If the market actually does roll over a little bit, we see a little pullback ahead of this November election here in the U.S. I'm not convinced that the dollar is not going to be the recipient of a move like that. So, as you pointed out, Stelios, could we get to 102? Yeah. Could we get to 102.50, which would be the underside of this channel or this triangle, this breakdown? This is where we start changing minds. There's nothing more that changes a mind of traders than price. So, you get price breaking back above 102.50. All of a sudden, you'll hear nothing from dollar bears, and everybody's going to be a dollar bull. So but what is the catalyst? Is it risk aversion? Is it maybe U.S. exceptionalism, versus the rest of the world? Who knows? But that's the levels that I would be looking at. And I agree, Stelios, we could get up there. That's where the rubber is going to meet the road as far as the dollar goes.
I will become bullish the dollar at some point, just not yet. I'm not saying I'm never going to be bullish the dollar, obviously.
And you know what? You've been right. I mean, and a lot of us have been playing the dollar to the short side. And I was actually thinking the dollar could actually have a longer term breakdown, over the last couple of weeks. But as you can see, it is now starting to really find its footing, and a lot of that has to do with just the rest of the world is starting to show some weakness as far as data goes. Hey, speaking of weakness, don't forget crude oil. Man, yes, there's tensions are rising in the Middle East. No, it isn't having an effect on crude. Maybe because the strikes have been limited this far in Lebanon. I don't know, but crude oil still very weak. I sure as hell wouldn't want to be on the long side of crude. Now we have just about a minute or two before we bring Patrick in from Bad Charts. I've never interviewed him, but he's going to be here with us this morning. I'm going to go find him here in a second, but I'm going to go around the horn and let's go to Ryan while I go look for Patrick. Ryan, what are you looking at today as far as any good setups at this point?
Yeah, I'm trying to catch the knife in euro dollar at the moment down into support. I did have my longs from 110s. My stop was at 110.60, but apparently there's some bids 110.60, 50. So I've started buying it small since 111.05, and I'll buy it down to this 70 level, see what it wants to do from there.
What happens if it breaks? How about if it starts to break through 110.60?
Yeah, if it goes through there, I'm going to be stopped because I think it probably goes a bit further. We probably get down to 110. I think if that happens, much like I've been saying the last couple of days, if you know, when you fail at a big level up top at that 112, you know, the buyers are going to give up after a certain period of time, and then you see a steeper pullback, and you know, going through the tech level here at 70s will probably be the catalyst for a few more to throw in the towel.
All right. Anything you're looking at as far as the yen goes? Because we basically just recap here. We came down to a long-term 618 retracement. If you guys don't even know, if you don't know that, I'll have to show you. This is from here to here, just so you can guys see around the 140 levels, a 618 retracement. We basically did a false breakdown, rallied above that. We hit the 618 of this most recent move with the new prime minister. We rallied, stopped at the 618 here. So are you looking to buy the dollar yen or sell the dollar yen at this point?
No, I'm long. As I said earlier, I'm long already, all the way down to 142s. So I'm looking for another move up. I wanted to take a bit off if we got up to that fib 144, 50, 60. Missed my opportunity earlier, but yeah, if we get above there and it's quite a big level, then I think we're on for 145 again. But as we've been saying, nothing moves in a straight line, particularly in yen pairs. So if we pull back here, 143 and a half ish, 45, 50, that's the level to look at. Just a one above.
Yeah,
where the low was today.
Here's the thing. I'd like to play the dollar yen on the long side after selling mine yesterday from being long down here. I sold mine yesterday a little early ahead of when we got towards the 50% retracement, I think is when I got out, somewhere around there. I don't know if I want to buy it today if the data is weak. I mean, if we have weak ISM or a weak JOLTS, jobs opening data, I don't know if I really want to stand in front of the yen. I don't know. It's going to be a trickier one for me. But thank you, Ryan. Appreciate your input there. And Stelios, anything that you're looking at today?
Quick answer is no.
Okay. Well,
sorry.
Then quick response is thank you for your lack of response. All right. Well, guys, Steve, Stelios, Ryan, thank you guys so much for joining us here at F.A.C.E and keeping me company while Dale is out, and we appreciate you being here. I'm going to bring in Patrick here in a second, but I do want to say this. We extended our 8-year anniversary sale just for, I think we're going to push it out until this weekend, just because we had multiple requests, because today is the 1st, people are getting paid. So we're like, okay, we'll extend it. So we're going to extend our anniversary sale, and then you won't see it until probably after the new year. It would be my assumption. So take advantage, especially on the semi-annual and annual subscriptions, because that brings your cost well below $100, I think, if you do that. So take advantage of these pricing while we have them. And also, we have a non-farm payroll. Ryan, do you want to talk a little bit about the non-farm payroll giveaway that you do?
Yeah, non-farm payroll competition is open. I'll stick the link in the chat there. As always, answers on that tweet only. Some great prizes there from Live Squawk, us, coaching, Peak Suite, the whole lot. So tons of good prizes there. So get your guesses in.
And so only answer to the tweet that says that has this icon, non-farm payroll. You answer here. If you answer, if I say something and you answer to me, you're not going to be part of the giveaway. Ryan, he does this every month, and if you are a ForexAnalytix subscriber, do it anyway, because if you get a free month of ForexAnalytix, we just tack it onto your subscription.
Then
It's
click that image, head to the blog post for the full rules. You need to make sure you know what the rules are, because if someone's already picked your number, you won't get it, but you can pick another one.
well, there you go. There you go. Well, thank you, Ryan. Thank you, Stelios. Thank you, Steve. I appreciate you guys. And I'm gonna bring in Patrick from Bad Charts. Patrick, good morning. Happy Tuesday. Happy Turnaround Tuesday. Welcome to the F.A.C.E show. How are you?
Hi, Blake. Yes, I'm doing great. What was that? A turnaround Tuesday? What? I've never heard that expression before.
Never. Yes, today is it's Mutual Fund Monday and then Turnaround Tuesday. So, and matter of fact, it happened to be end of month Monday, and which we saw a nice little boost in the equity markets at the end of the day yesterday as those end of month flows came through. And now we get Turnaround Tuesday. So, what say you? Do we actually get a turnaround in the markets?
Well, yes, it's all that question. It's all about time frame, right? Because I see, like, I used to do like you guys, well, 4 hour, 8 hour candle charts. But when you zoom out, then you see the bigger picture. It takes a lot to turn around a market, like from a macro cyclical or secular type of move, right? And what's good about yesterday, it was not just a monthly close, it was also a quarterly close. So for me, the most important dates for traders, well, their monthly closes, you get 12 a year, then the quarterly closes 4 a year, the semestrial closes, the one that the second quarter when it closes, and then the most important trading day of the year for me is the last day of the year, because then you get annual yearly closes, and that removes a lot of the noise, and you really get to see the bigger trends in play. And why that's important is the shorter time frames. Sometimes, of course, you could zoom in. That's like Inception. You could zoom in and you could play ups and downs. But if you don't have a view of the bigger picture, then let's say you're trying to short in an uptrend, you're playing counter movements, right? They're riskier, right? At any moment, like you said, those capital flows could come in at the end of the month. The pension funds, the mutual funds that had their planned buying, right? Let's say they start buying at the wrong moment when you were trying to short something that looked bearish on your smaller time frames, you'll get the rug pulls. So I would rather, if I know that I'm in an uptrend on the yearly chart, the quarterly chart, the monthly chart, then what I'm going to look, instead of trying to short that, I'm going to look to buy corrections that end. So bull market, corrections, wedges, whatever, that's lets the price consolidate on those higher time frame moving averages, and then I'll play those bounces off the longer term moving averages. I don't know. Should I share a chart? Could I share my screen?
Absolutely. So, tell us a little bit about as you're going to do this. Tell us a little bit about your thoughts as we head into this election season. I mean, we are obviously I'm assuming you're in the U.S. Is that incorrect?
No, I'm in Quebec, Canada.
Okay, so you're in Canada. So how are you viewing this U.S. Election season from the north?
It's for me, it's like popcorn season. It's drama. I love the way you guys do politics. It's crazy. It's like so much more fun than what we have here. Here it's like, oh man, it's like it feels like we've had our prime minister like for ages there. But yeah, no, it's a big drama show there you guys are having there. So from a charting aspect, from a chart trading aspect, I don't really care about elections. I know there's it's about like that seasonality charts. You often see that it says like people, they cut out the price and then they say they take all the January months, all the February months, and then they say this is the average gains over 50 years on January. Or some people do that on the election years, right? Each time there's an election year, on average, the market has moved X amount, right? But that's you can't trade off that, because if you're in a secular bull market and it happens that the election is in a secular bull market, then there's higher chances that even if it did go down previously on election years, it has a higher chance of going up, or just the inverse. Let's say you're in a secular bear market and it's an election year, like all the narratives, they're not going to let the market crash and they're going to do whatever they want. But then if you're in a cyclical bear or secular bear, then what do you want to do? You have more chances of that year being not tracking that statistic. So it's all fun, coffee table discussions, all that, but is it tradable action? Like in my weight of evidence approach, will I consider that? Maybe, but it's really like really far down the ladder of actionable intel. It's like, okay, but you can't rely on that, because I've seen so many people, I can't trade gold in whatever in August, or the expression, what is it? Sell in May, go away. No, what that?
Yes.
Is that it? But what happens if you're in a secular bull and you're in an uptrend, and or there's breakouts confirmed on the monthly close of May? Are you going to step out of the stock market and when there's crazy breakouts because that old adage is there? It makes no, for me, it's just like, it makes no sense, right? It's like people will remember the times that adage did work out, but they'll dismiss and they'll forget all the other times that it didn't work out, right? It's like we always seek bias confirmation, like let's say I respected that adage, I didn't play the markets, then I'll just try to remember the times that played out in my favor. But let's say the markets did rocket, I'm just like, my brain's going to dismiss it, right? Like we always, it's like a human reflex, right? All our bad memories, we try to, to just forget them, right? You drank too much alcohol, you did some stupid stuff at a party, right? Your brain's it's like a self-defense defense mechanism, right? It's going to try to forget that time. So if you're really trying to be objective and unbiased, then the best you could do is just stick at the charts, respect your framework, and forget all that sideline stuff there. Because I know I'm rambling on, and you're letting me ramble on. Usually Dale interrupts me when I go on these rants.
Well, I'm about ready to, so don't worry. I'm about ready to get there. Here's because I don't want to look. I'm gonna say a few things. You may or may not agree, but I've traded for about 30 years, and when I originally learned how to draw Fibonacci's was with an actual protractor on charts that I had to print out back in the mid 90s, and so I'm all about being a technician and understanding where the framework is and understanding where price is going, which I do believe is important. But if you don't have a basic understanding of what is driving price, it's kind of like driving with one eye closed down the road or down a freeway, going 150 miles an hour. So I like to confirm what I see on the map in charts by what might be whether it's a macro or different driver. You might call it noise. I call it probabilities.
Well,
and as traders, especially those of us that have traded for funds, and we have quarterly runs where we have to make money each quarter, and then we're back at a high water mark, and we have to make money. If we don't make money that quarter, we don't get paid for another quarter. We have to stack probabilities in our favor. So, I don't want to interrupt you, but there are some things that I might not necessarily agree with what you're saying.
Look, I started off, like everybody, have some money from my spare money. Then after that, I Google, invest. And then of course you always find the penny stock forums that never talk about risk and money management.
I never did the penny stock forums because usually penny stocks are penny stocks for a reason.
But yes, but I'll get to where you are. Then after that, I went down the fundamentals route and I tried to figure out, whatever price to earnings. And then I would go into all this the macro narratives. Then, of course, after that, I read Stan Weinstein's Secrets for Profiting in Bull Markets. And there was a chapter in there at the beginning that resonated with me. And he said, in the 80s or late 70s, the fundamentals, like the narratives around casinos, was terrible, just terrible. Nobody wanted to touch them. But he was looking at the price chart. The price had been consolidating, whatever, big base, starting to curve up, breaking up above resistance, above a 10-week, 30-week moving average. And it says, look, everybody... No, there's no attention, right? Because often when there's attention and we start talking about stuff, it's because something made us happy. The price went up. Then we start talking about it. We talk to our neighbors, and then you know the expression, tips are for waiters, or when your barber starts talking about something, it's not talking about it because it's in the basement or it's been basing for 10 years and just breaking out. He's going to talk about it because he heard somebody that made money, right? But about all this, the narratives and like what moves the market, let's say not the price, like what moves the market, but we don't know, like we think we know, but let's say we do know a part of it. It's, let's say you have analysts, researchers in your firm. Okay, we think this is going to move because the Fed's going to do this, or, you know, there's a supply shock in the oil sector, there's an embargo. Okay, all these things. That's what you do know. But if you're really, really honest with yourself, you got to say, there's something I don't know. There is, of course there is, because you have 10 analysts, 100 analysts, but how many analysts are there worldwide? There's thousands of analysts out there, right? You have the American, like, let's say you're analyst, but maybe there's a guy in China or in Russia, or maybe there's an Arab sheik that he has the opposite position of you, right? You always think from your perspective, but there could be somebody else that's going to take the opposite position, right? Because if everybody had the same position,
there always is. That's what makes a market.
Exactly. So the price, when you see the price chart, you're an analyst. You decide to buy $10 million. There's another analyst, he buys 15 million. There's another analyst, he sells 30 million. The aggregate of all market participants, all of them, all these analysts, everybody who has a reason to buy or to sell, all of them, guess where I see the result? I see in the chart. If the price is trending above, forget all these the lines there. If the price is trending above an inclining moving average, that is mathematically, objectively an uptrend. That means the price keeps going up, the moving average keeps going up. I'm in an uptrend, no matter what the reasons. Let's say in this bull run from the 1980s all the way to 2000 for the US stocks. This is a yearly chart, guys, for the SPX. I'm sure at any of these moments, it was crazy narratives in one way or the other, depending on which side, what's the components of your analysis you were looking at that was coming in your research at that particular moment. Some weeks, maybe you got some bearish elements, some weeks you got bullish. And then after that, of course, all the other analysts are doing their stuff. Then they're recommending their funds to buy whatever they're buying. But at the end of the day, the chart, there is no lie. The chart is the fundamentals, and it's even better than it's everything.
But I want to ask you something. You know, when you're looking at a chart, just like, you know, I look at charts too. Everything that I'm going to do from a charting point of view is I'm going to say, well, I'm buying here because I have the highest probability, lowest risk versus reward. I can stack it in my favor. That's where I want my entry point's going to be. But if I could throw in additional reasons why I should be buying there is for this narrative that is behind the market, wouldn't you want to do that as well?
No, I'll tell you the trap of that. And this is the trap of let's say the gold bugs in the 2000s, right? I'll put up the gold chart just to show you guys. I'll put it as a backdrop. In the 2000s, the narratives always looks most bullish. The story always looks most bullish at the top. So I remember back here, let's say I have a narrative for buying. Okay, let's say I buy gold. I think, let's say in 2000, whenever I decide to buy gold, because I don't trust the central banks. I don't trust the Fed. I got to protect myself against purchasing power. Okay, that's my narrative. I looked at the chart, let's say, or I didn't look at the chart, and it was a breakout. Price goes up, and then it reinforces your narrative, your story. Oh, my narrative is making the price move, not the aggregate of all the different narratives. You start to believe that it's your narrative that's moving it. But what happens when the price starts breaking down? Like, let's say here, it started breaking down, and the narrative has not changed. And at the opposite, it probably looks the most bullish. 2011, I think the Greek banks were failing. Italy was failing. Europe was a catastrophe.
Oh, I was broadcasting live, and I'll tell you exactly why I sold it there.
Yes. Yes.
Yeah, but yeah, I'm here.
But sometimes you get lucky, you know, but a lot of people, they bought here because of the narratives, right? But the price is breaking down. The market is forward looking. The narrative that you have today, unless like you're really able to discount it in the future, and you think that the market is not as smart as you, and they haven't figured it out before you and start pricing it ahead of you, then you're one step behind. If you listen to CNBC, you're one step behind. If you listen, unless you're like a true insider with really some intel that's really like in depth and forward looking, like 6-7 months, you're gonna be behind the curve. Where you'll never be behind the curve is the price. Never, because the price is what's happening right now. You know, no matter what the reason why gold failed here and didn't recover, right? It could have recovered.
Well,
I'm sure some
price
people,
is the ultimate judge and jury in the markets.
yeah. Look, if I had a narrative here, it broke down. I could have said, "Oh, it's an around the apex move. It's a false breakdown. It cannot break down." And then I hold on. But then I hold on. Oh, I'm losing. And then what do I do here? And I'm probably going to sell at the bottom here. I'm going to capitulate when that thing starts basing. But then after that, when the price starts going back up, I won't believe it. Look, just believe the charts. You cannot make money if the price does not go up and away from your entry point, right? You just cannot.
Yeah.
So, and there's opportunity
it's
cost.
funny that time frame. There's a lot of people that are listening on this show that probably listen to my show over, in that 2011 time frame when I actually had to talk a friend's father off the ledge of and putting his whole IRA into gold at that point. So that was my sell indicator. So yeah, it's interesting.
Yes.
So Patrick, what you're basically saying is you only follow price. Narrative doesn't matter.
Yes, it's noise. It's 100% noise. I love talking about it. A lot of our members, like, they need the story because, look, I'm a chart geek. I'm like, maybe I don't know if I'm super analytical, and for me, just looking at the price matters. But people, they need a story. They need to tell their wife a story. Why did they put 40% of their income in gold or in uranium stocks or in Tesla? You need a story. That's what Elon Musk sells, or they sell people. They sell you stories. It's much easier to sell a story that hits an emotion chord than to sell a price chart, which is super boring. It's above an inclining moving average. What? Try to explain that to your wife why you put your money in there. Try. She's going to say you're crazy, right? She's not going to understand the reasoning behind it. So stories, sometimes, as a pure chart trader, I go on a war on Twitter sometimes against fundamental guys. I shouldn't do it. I should just focus on what I'm doing, but it's because I'm fighting the CNBC machine. I'm fighting the human nature. That's why we're terrible chart traders. Humans, we're terrible, I won't say chart traders, but we're terrible traders because we're not built, our emotions are not built to buy when nobody's talking about it, right? We're going to wait until there's gains. And then after that, we're going to buy when you're stretched. Here's my super indicator, Blake, that I love. That's stretched from the moving average. At the bottom, I'm stretched from the 36-month moving average. That's that red line, right? And look how stretched you are. Look from a statistical point of view. Most of the data points here, the 1970 blow-offs, but from a statistical point of view, there's more data points below that red line, right? It's resistance. You could do that on any chart than above, right? So whenever the price is getting closer here, it doesn't mean it's a top, but you're in outlier. You're in outlier territory, right?
What moving average do you have up there?
That's a 36-month, and and at the bottom pane is a distance from the 36-month.
Yeah. Okay.
So it's super. I don't use a lot of indicators. The better the chart trader, he needs less and less indicators. But this one, it's pretty close. It's not fancy math off the moving average, right? It's just like a good chart trader could see when prices stretch, right? You could see it visually here, right? When the price is above. But when you see it on a chart and you draw resistance on an indicator which measures that, it makes it much easier for somebody who's just starting out. And I use it all the time. So I know gold or any chart, we could have done this for anything. Once it gets here, look, there's not much room left, Blake, for gold to run there from the moving average.
Wait. You're not gonna double up and go quadruple long here?
No, because you know where the lowest entries are? When you're coiled and tight. Look at here, down here, coiled and tight. It doesn't mean you're breaking out, going to the moon. But if it's coiled and tight, that means nobody's been talking about it. It means it's been basing. Because for the moving average to be coiled and tight to the price, you need a base. That's why, the most beautiful chart patterns are bases with a horizontal breakout line, whatever, inverse head and shoulders, double bottom, a box, a rising triangle, whatever you want to call it there. But they're coiled and tight, price higher lows, price aren't doing higher highs, And once you break out above that horizontal line, what you're actually doing is you're having a new higher high. So higher lows plus higher highs, that's the definition of an uptrend, right? So gold, there's no entry here. You know, if you're in on the monthly chart, you just ride it until the momentum, as soon as you, like, it's begging for consolidation. Like there's a pull flag that's imminent. Like I don't want, but you still have to wait. Eventually there'll be some type of flag here, halfway patterns. You see them all the time, right? That's the building blocks of any uptrend is pull flags, right? But either via pennant, an expanding wedge, but that's what it is, right? It's explosion and move, consolidation, letting the moving average catch up until one day that consolidation pattern becomes a top, and you'll only know it in hindsight. So this is what I like to say is all bull market tops start with a bullish looking consolidation pattern that fails, but not all bullish consolidation patterns that fail are market tops. So this one failed. It did become a market top, but if it would have continued, it would have been crazy, but you were stretched from the moving average, you know?
So let me ask you this. I know you don't pay attention to, well, I guess what's going on or how, economic data, but does your positions, do you care that there's you know, that we have non-farm payroll this week?
Yes. 100% I
Okay.
care. You know why? If I can chart it, I'm fine with the data. So what I do here, I put in my tagline, I call it chart defined macroeconomics. So instead of me having a narrative defined on what the macroeconomics are, you know, I know, like, well, supply and demand, of course, but you know, all the macroeconomics, what I do is, okay, I'll look at the evidence. I'll look at what the aggregate of market participants are telling me what the macroeconomics is. So let's see. Well, hold on. I'm just going to get this one here. Okay, it's kind of fuzzy. Here I have the unemployment rate. See, that's an economics data series, right? So I do care, but I'll do some TA on it. I'll do some analysis, and then often I'll see what correlates with it. So don't confuse, guys. The causation, I practically don't care, but I do care about correlation. Even if it's bananas that correlate to a chart of unemployment, of course I care. It's correlated. If I could play bananas going up, I'm not smart enough, or I know I'm not smart enough to try to identify the cause of why there's a correlation, and I don't care. I just want to make money. So the cause, people could have fun. Because imagine if this is another thing about like fundamentals and areas. What if there's no apparent cause, but the price is tracking another instrument correlated and it's breaking out? Am I going to refuse to play it because my brain can't wrap myself around the story of why it's going up? You know, sometimes sugar was breaking out. Some people tell, well, it can't be going up. There's a surplus of sugar. Well, what do you want me to tell you? The price is going up. Like, there must be something, right? There's something that you don't know that's making it go up. So here I have unemployment rate. And here I have at the bottom, I have the 7-year rate of change, that blue line. And here, and then I have the ASA chart. The ASA is the gold and silver miner index since 1968. Not all the time. Again, it's like about probabilities, right? But I know that often when the unemployment rate bottoms and starts turning up at this angle of ascent, the miners, that's when they have their best periods. There's other elements. The gold to SPX ratio loves turning up, and often, and I haven't seen it when the unemployment rate goes up from this low to this much high at that angle. It rarely, I haven't seen one occasion where it doesn't double at least the unemployment rate. So if people are wondering, like, you know, often people, I often do like financial spaces every Friday, and they don't understand how come the Fed's cutting, the initial claims aren't that bad, and they're spinning what they see the data. But then when I look at this chart, then I say, okay, well, the Fed must be looking at stuff that people maybe don't know where they're looking at, or they're looking at other stuff, but this is probably spooking them there, that the unemployment rate, they see the angle that thing's rising, and it's going to at least double from, you know, wherever it is now. And that's like probably one of the reasons additionally where they could decide to keep cutting rates. So even me, sometimes, you know, I fall into the trap of, I could attach narratives, but as long as they're backed by the charts, it's fine. But again,
well, that's exactly what we were talking about earlier. It's like, yeah, you have a narrative, but as long as it's following your price narrative, your price breakout, doesn't that just increase the probabilities of you making money if you can have your narrative match what price is doing?
Well, what if I'm wrong? What if I think my narrative is moving?
We're always going to be wrong.
But so it's useful.
I'm wrong at least half the time.
But not for the trades. Yeah, for the trades, like me too. Like it's all about risk and management, right? I'm right less than 50% of the time, but because my trades yield the 3-to-1 risk to reward, it's mathematically, over time I should make money. But what I'm saying is the narrative. If I attach a narrative to the chart I just showed you before. But what if it's not even that? what if it's something else? That's the cause of why they're correlated, those charts. Isn't that dangerous? Isn't that dangerous information? I'll sleep well at night, but it's like,
well, as long as price is moving in the direction you are forecasting it, then isn't it going to help you sleep better at night?
If I have a narrative and if the price moves in the direction that I want, I'm happy. If there's a narrative, right, and the price and the narrative goes in direction, it's a double-edged sword. It might make me feel good, because I'm still a human and I hear stuff. Okay, silver has to go up because there's solar panels and stuff like that. Whatever the narrative, even in a bear market, that narrative is still there, but people just dismiss it, right? It's because, like, in bull markets, even bearish news is spin positively, right? You know how they, despite bad earnings, Tesla goes up. In a bull market, you'll hear that, right? Or in bear markets, despite good earnings, markets frown upon that and the price goes down, right? So if I have a narrative and it feels good to me and it seems reasonable and I start attaching to it, I'm opening myself to getting trapped later on if ever if ever the price doesn't go in my direction.
But if you're watching your charts and you're using your charts as your guide, then
I'm fine. I'm fine. I'm just saying it's dangerous because I'm opening a door to something that might make me take an emotional decision. And that's why chart trading is hard. We fail because often our emotions interfere with our trading framework. Like, you got to be a robot to close everything out, right? You got to be some type of, autistic on the spectrum. Like, you have to be, it's hard to be a trader because you have to.
Oh, I think we're all on the spectrum, Patrick. All of us.
We have to, right?
Yeah, we have to be. Hey, listen, we're as far as time goes, we've got to get wrapped up because we've got to head out to our ForexAnalytix subscriber show. But it's been an interesting conversation. I look forward to actually having another conversation with you the next time Dale pops in. But I'll stick around and make sure we continue this conversation. Patrick, what's the best way for traders to follow your work?
Guys, go on Twitter, X BadCharts1. Of course, I have a website, northstarbadcharts.com. It's behind a paywall, but we just have so much time to help and answer people on Twitter. So if you want special attention there, go to the website.
All right. Well, hey, I appreciate you being here, and like I said, I like your longer term framework, and I do agree as far as there's nothing that changes narratives, and I said this just before you came on about maybe 15 minutes ago. There's nothing more that changes the narrative than price. You get price going in one direction, narratives are going to change no matter what. Yes. So that's the bottom line. So I'm with you as far as that goes. So Patrick, it's been nice chatting with you, and thanks for gracing us here on the F.A.C.E show with your presence. We do appreciate you.
Thanks, Blake. I hope I wasn't too aggressive there in my philosophy there.
No, hey, you know what? I love it. The thing is, when we trade the markets, you got to trade by your own tune, and there's a lot of different ways to slice and dice this market. As I always tell people, it's my way isn't necessarily the right way. It's just the way that I do things. And and finding a trader or a way of trading that jives with each individual trader. That's what half of this game is about. So Patrick, thank you so much for joining us, and I know Dale's going to circle back around with you when he gets back from out of town. He has apologized. He had to step out for a last minute trip. You're muted.
Yes. Thank you, Blake. I appreciate you guys. I love Dale, and it was very fun there talking with you, Blake. Really appreciate
All
it.
right, same here. All right, guys. And I want to thank you all for being here with us today. Thanks, Patrick, for joining us here on the F.A.C.E show. And remember, catch Ryan on the Flow show every European morning. I think K-Man's going to be back on Thursday this week. And good luck today trading through the ISM data. And then don't forget, we have JOLTS data coming up this morning too. For those of you in the ForexAnalytix community, I'll see you in about 10 minutes on the morning edge. All right, everybody, have a great trading day. See you tomorrow if I don't catch you there. Bye-bye.